Hi, and thanks for joining me. My name's Tim from Think Property Business. Today's video is a market update for March of 2022. Whether you're buying your first investment property or perhaps even building on your current portfolio, hopefully you're very aware that it is critical to get a balance between affordability and obviously capital gains in the properties that you're putting together. So hopefully this video allows you to help you with your analysis and feasibility around what it is you're looking to achieve in your property portfolio. So obviously all of us as investors want to be successful, and we want to make sure that we invest safely. So I hope this, again, this video allows you to think more about what it is that you're looking to gain from your portfolio, and who are you as an investor, what are those outcomes going to look like, and how can I make sure that when I do invest, I see out the journey to be able to realise those capital gains. So I hope you enjoy. So if we look at Australian dwelling values, state by state, we can see that there's three sets of figures below each capital city. The first one being for the month in February, second quarter, and then the third one is for the 12 months. So by looking at the data, we can see that Brisbane's been leading the way, 1.8% increase in dwelling values for the month of February, 7.2% across the quarter, and then 29.7% for the year. And closely followed by Adelaide, 1.5% for the month, 6.4% for the quarter, and 25.8% for the 12 months. On the other end of the scale, Sydney actually had negative 0.1% change to dwelling values for the month of February, and Melbourne had 0% growth and has only had 12.5% growth for the year. So we're starting to see that there's a bit of a trend that happened through the last couple of months where capital cities aren't sort of keeping pace with each other. As a lot of people have stated, that Brisbane will lead the way in capital gains through 2022 and beyond for some period of time. But again, then we can see there are actually some capital cities that are starting to slow down with the growth rate and an easing off in those capital gains in several of the capital cities. An overview of the Australian dwelling values, we can see for the 3 months, national home values rose 2.7% in the 3 months to February, which has eased from a peak of 7% in the 3 months to May 2021. For the 12 months, dwelling values in Australia are 20.6% higher over the past 12 months, which is down from the recent high of 22.4% in the 12 months to January. So again, things are slowing down. Capital cities in the 3 months to February, capital city homes saw the top quartile of values rise by 0.8% compared to 3.4% across the lowest quartile. So the more expensive properties, that market, if you like, or that section of the market is starting to slow. Whereby the more affordable end of the housing prices is still moving along, and compared again to the top end, it's actually doing a lot better. So that goes with affordability, and obviously there's a larger market that can afford the properties at that lower end than there is for the top end of any property market. So if we have a look at the property market indicators, so 3 being median days on market, vendor discounting, and auction clearance rates. So for the median days on market, 3 months to February, in the green the figures are for this year 2022, and in the purple for 2021. So across Australia, 30 days for 2022 currently, where there was 32 days in 2021. Combined regionals, 33 compared to 36, and then the combined capitals, 29 days, steady with 29 days for the same period in 2021. So vendor discounting in the middle column, 3 months to February, again in the green for 2022, in the purple for 2021. Australia minus 3% compared to minus 2.9%, very similar, as is for the combined regionals, minus 2.8% compared to minus 2.9%. And again for the combined capitals, minus 3.2% compared to minus 3.2% compared to minus 2.9%. And then the third column for the auction clearance rates. So clearance rates averaged 72.4% in the 4 weeks to February 27th, down from 78.8% in the equivalent period of 2021. And clearance rates are expected to trend lower amid softer housing value growth. So currently sitting at 72.4%, so still pretty strong, but will trend lower based on the softening of the housing value growth as we've seen previously. A quick look at housing cycles, just generally speaking. So we can see Melbourne, Brisbane, Adelaide, Hobart and Canberra all have current dwelling values at record highs, whereas Sydney dwelling values are now minus 0.1% below the previous record high in January 2022. Perth dwelling values are now minus 1.2% below the record high in June 2014, and Darwin dwelling values are actually minus 14% below the record high in May 2014. So interesting again how those capital cities of Melbourne, Brisbane, Adelaide, Hobart and Canberra all have their current values at record highs. So it's been a very, very interesting year or so with capital gains across those capital cities. So the 3-month changes to the Australian dwelling values, we can see Australia has recorded 2.7% growth, and combined regionals of 5.7%, and then combined capitals 1.8%. So as we saw in the last report, the regionals are actually outperforming the capitals. This is due to people relocating, moving out of the cities to these regional areas, affordability, being able to work from home, lifestyle, etc. So obviously when that happens and there's a population increase, that puts a demand on the requirement of new homes or homes to live in, which then obviously supply and demand, then determines what the market value will be. So again, yeah, those regional areas outperforming the capital cities. Now for the 12-month changes, we can see for Australia 20.6% compared to 22.2% last time we looked at the report or the market. For combined regionals, 25.5%, that's up from 25.2%, and then combined capitals, 19.2% compared to 21.3%. So again, there's a softening of the capital city values, whereas the combined regionals, the regional areas are actually performing quite strongly. And then generally across Australia, that growth rate has slowed as well. Quick look at gross rental yields. So this is for February 2022. For Australia, 3.2%. Previously, it was 3.2% as well, so it's holding steady there. For the combined regionals, 4.1%. Previously, 4.2%. And the combined capitals just down at 3%, whereas it's 3.2% previously. So, again, the combined regionals, stronger gross rental yields as those prices increase. Obviously, it's a relationship between the rental income, annual rental income, and the purchase price. So again, as the regional areas, the capital growth continues, then we probably see those gross rental yields reduce further. Okay, so if we break down the gross rental yields to each capital city, we can see Adelaide 3.8, previously at 3.9. Sydney way down at 2.4%, was holding steady. Melbourne also down at 2.8%. Across there, we can also see that Darwin is at 6%, was previously at 6.1%, but quite high compared to the other capital cities as far as the gross rental yield goes. If we then look at the gross rental yields for the regional areas, South Australia 5.3%, which is down from 5.7%. Queensland 4.4%, down from 4.6%. Northern Territory 7.1%, down from 7.3%. So you can see across those other regional areas in the different states where it's trending, and obviously again with those price increases relative to the annual rental returns, then that's going to determine, obviously, and that's how the yields are calculated. So as the prices increase, generally speaking, the rental returns don't increase at the same time, so they're held back a little bit. The prices, capital gains, run away from those rental returns, and again, then you get those yields that become less and less because of that the differential between the purchase price and the actual current rental return. Okay, so finance and lending. So for investors, nationally investor finance comprised 32.6% of new mortgage lending through the month of January, up from 31.5% through December to 2021. For first home buyers, nationally, first home buyer finance as a portion of total owner-occupied finance has fallen from a peak of 32.5% in December 2020 to 23.7% as of January 2022. So first home buyer participation is lowest across New South Wales at 20.3%, down from 26.7% in January last year. So that's a little bit of an overview of finance and lending, both for investor finance and first home buyer funding. Let's have a look at the RBA statement highlights. So the cash rate target was again held at 0.1%. The RBA identified the war in Ukraine as a major new source of uncertainty, particularly with respect to inflation pressures globally. The RBA noted resilient economic performance, with the economy seeing an upswing in business investment, unemployment sitting at a 14-year low, and underemployment near its lowest level since 2018. Strong house prices were acknowledged, but the growth in housing values was easing in some cities, and the importance of adequate lending buffers amid record low interest rates was also mentioned. So a summary of the property market for Australia: the rolling 28-day growth rate in combined capitals home value index slowed through February. Home values were just 0.3% higher in the 28 days to end of February, with demand slowing amid tightening lending conditions and affordability constraints, while supply levels tended higher in some regions. Sales volumes rose 37.7% in the 12 months to February to an estimated 650,175. Transaction volumes through February remained elevated at an estimated 57,427, which is 46% above the previous 5-year February average. More advertised stock is being added to the market than usual. At the national level, the 4 weeks to March 6 saw new listings trend 4.8% higher than the equivalent period of 2021. In the year to February, Australian rent values increased by 8.7%, which is down from a recent cyclical high of 9.4% in the 12 months to November. And a continuation of the summary: through February, growth in Australian rent values 0.8% outpaced property values by at 0.6%. This led to gross rent yield stabilising at 3.21% over the month. This marked the first time in 17 months that gross rental yields did not decline. Detached house approvals fell by minus 17.3% through January, following a surge in approvals between August 2020 and December 2021. Unit approvals totaled 4,045 in January, which is the lowest read since July 2012. Low mortgage rates continue to incentivise home buying activity, but fixed rates are rising. Long-term fixed rates are now higher than the pre-pandemic levels. And then regulators and policymakers are closely monitoring lending standards, as they have been for some time now. Okay, so thanks again for joining me on this video. I hope you found it informative and you got something out of it that you can take away to help you with your analysis and help you become a better property investor. There's a fair bit happening. There's still opportunities for us as investors. It's not too late to get into certain markets and actually achieve those capital gains. As we saw, not all areas are performing at the same time, at the same rate. So again, if you do some research and understand what drives markets and where the markets currently are, how long they've been in particular cycle of that property clock, if you like, then that can help you. It certainly does help you be able to then make informative decisions and commercial decisions around how that purchase is actually going to benefit you and your portfolio. And obviously, again, it's about affordability. We want to be able to see out the journey so that we can reward ourselves for being sensible about how we invest, be responsible about how we invest, so that at the end of the day, at the end of that journey, we can realise those capital gains by being able to support that portfolio through that given period of time. So thanks again, and I look forward to catching you on the next one. All the best.